What if choosing the right ETF today could transform your financial future? Two of the best ETFs out there are SPY and SCHD. You want to know which one is the ultimate wealth building machine? Stick around, because in this video, we are putting the two ETFs head to head to uncover which one can supercharge your wealth building journey. And while breaking down their performance and potential, we'll be able to see what makes each one a game changer for the long haul. Choosing the right ETF today could mean massive wealth tomorrow. Let's dive in. So, almost everyone knows about the Standard & Poor's 500, otherwise known as the S&P 500. This stock market index is made up of the 500 largest companies listed in the United States stock market. As it indicates the overall wealth of the US economy, the S&P 500 needed a comprehensive way to track its performance. A stock market index that is as large as the S&P 500 couldn't be bought or sold, but there are financial products that track the value of indices, such as the S&P 500, for investors and traders. And this is where the SPY comes in the picture. The SPDR S&P 500 ETF Trust, or SPY for short, is an exchange-traded fund that tracks the performance of the S&P 500. SPY was established in 1993 and was the first index ETF listed in the United States. Since the S&P 500 includes 500 of the largest publicly traded US companies, it makes SPY a quintessential choice for investors. With an expense ratio of just 0.09%, SPY has consistently delivered robust returns. Over the past decade, SPY has annualized returns between 10 and 15%. And these returns were majorly driven by the strong performance of tech giants like Apple, Microsoft, and Amazon. Now, because SPY has more exposure to the market, it exhibits higher volatility. So, for investors who prioritize stability over aggressive growth, this may not be the ideal choice. However, SPY's ability to recover after sharp declines is what attracts investors. In today's economy, investors tend to seek higher returns, and while SPY offers some exposure to dividend-paying stocks, it doesn't prioritize dividend growth. As an ETF with a primary goal of mirroring the S&P 500 index, it focuses more on capital gain than reinvested income. There is no doubt that SPY has the best portfolio out there. With holdings in companies like Apple and Microsoft, and having dominant stock growths, SPY has a balanced exposure to all sectors. S&P 500 might feel like a sacred option to invest in to investors who have been in the market for too long. But truth be told, it's not as glorious as it may look on the outside. It is obviously a powerhouse, but with its heavy reliance on the performance of a few tech giants, it has become vulnerable to industry-specific risks. So let's say if the technology sector experiences a downturn, the overall returns of SPY can suffer greatly despite having 500 companies in its portfolio. It really lacks diversification across industries. SPY's expense ratio is low at just 0.9%. But there are other ETFs with even lower expense ratios, and that includes SCHD too, but we'll get to that in a bit. Regardless of that, SPY remains a favorite among many investors due to its proven track record of long-term growth. The way it recovered from market downturns in the 2008 financial crisis and the COVID-19 induced crash in 2020 is truly commendable. But in this new economic era, more and more investors are looking for consistent payout opportunities. And that may not be the case with the S&P 500 because of the market downturns and the sharp drops. Now, let's move on to the SCHD, or the Schwab US Dividend Equity ETF. This dividend-oriented ETF from Charles Schwab was launched in 2011. And as of now, it has more than $37.7 billion in assets under management. SCHD tracks the Dow Jones US Dividend 100 Index. Designed to measure the performance of high-yielding stocks issued by US companies that have a consistent record of paying dividends, the ETF is evidently growth-oriented. Currently, the SCHD holds 103 stocks and offers a 30-day SEC yield of 3.49%. That's literally more than double compared to SPY's 1.1% yield. For the past 5 years, the SCHD has grown its dividend at an average annual rate of 12%. Having a price-to-earnings ratio of 18.4, the SCHD is a cost-effective option. If you are to compare it with SPY's 28.1 ratio, It seems like a good option if you are looking to invest in less expensive companies. To some, this comparison might seem absurd, since SPY and SCHD have really different sector allocations, but they both have holdings in a few of the biggest players in the market. SCHD's top 10 holdings make up 40.5% of its portfolio, and none of these holdings overlap with the S&P 500. And yet we are at a point where both these ETFs are competing with each other. However, if we talk about the overall holdings, they do have a few names in common, but it's only an 8% overlap to the S&P 500. SCHD's holdings include companies like Johnson & Johnson, Chevron, Verizon, and even Texas Instruments. Having holdings in pharmaceuticals, oil and energy, telecommunications, and the tech industry, this ETF is pretty diversified. Currently, the three largest positions on SCHD's top 10 holdings are taken by Cisco, Bristol-Myers Squibb, and Home Depot, with each of them representing about 5% of the fund. One look at the reports and you will know that these companies have a strong history of consistently paying and growing dividends. Literally, all top 10 holdings of this ETF are durable, cash-rich companies with long histories of rewarding shareholders through dividends. And the cherry on top? Low cost. Having an expense ratio of just 0.06%, the SCHD is not just income-focused, but it's also a low-cost alternative to SPY. The expense ratio plays a huge role in the ETF's growth. Paying only $6 of fees on a $10,000 investment seems like a pretty good deal. Featuring an attractive dividend yield of 3.6%, which is almost triple the S&P 500's 1.3%, the SCHD has shown quite positive results. The ETF has an annualized return of 4.2%, an annualized 5-year return of 11.1%, and an annualized 100-year return of 11%. If you're looking forward to buying SCHD stock, then you should probably know that it earned a moderate buy consensus rating based on 55 buys, 41 holds, and 5 sell ratings in the past 3 months. There is no doubt that the SCHD ETF is the new investor favorite. Over the past 3 years, it has taken in $27 billion of net new money. We believe that the standout feature for SCHD is that it is focusing on high dividend yielding companies with a history of consistent payouts. That makes it an ideal choice for investors prioritizing income and dividend reinvestment over the long haul. With its diversified portfolio of blue chip dividend stocks, the above average dividend yield, and of course, the favorable expense ratio, I would love to invest in this ETF. There you have it, a detailed analysis for both ETFs. Which one of these are you inclined towards? Let us know your thoughts in the comments below, and don't forget to hit that subscribe button so you stay in the loop and won't miss out on any of our videos. Subscribe now. See you in the next video.